All right, so it's been a while. I apologize for such a long period of absence, but realistically, we only had this last kind of section to tie up before I think you're fully equipped with the fundamentals for commercial banking analysis, anyways. So today we're just going to cover a couple of topics, but on a very high level. Every bank or every financial institution does each of these things a little bit differently. So there's no one standard way to approach these concepts, but I think it's actually one of the more interesting things about lending. And it actually gets into the heart of lending. I know so far we talked about assessing a business's, you know, performance based on their income statement, cash flow statement, and then the health of their business based on their balance sheet. But now we're going to take a look at creating an operating performance assessment, just a very, general overview. And then we're going to look at how to do some basic margining, and this relates to businesses that need a line of credit. And then lastly, we're going to talk a little bit about loan to value. So bear with me. Let's get started here. I'm going to find my pen. Let's do red test. Okay, that works. So on the screen here, on the left side, we have two kind of I've already laid out the tables, and I've created these on Excel. So the screen might look a little bit busy, but it's actually really, really intuitive. So on the left side is what you would enter into a fresh page on Excel. This is when you're doing your operating performance assessment. Okay. When you look at the financials of a company, what everyone likes to do is first you go straight to the income statement. You take a look at the past few years of their results, and in this case, I just have two, and you're just gonna make some assessments, and I like to put it into Excel so that it's easier for us to really understand the numbers. On the left side, it's straight up a copy and paste right off of the financial statement. Now, making the columns, right, you just put your names into the columns, and then you put the numbers into the different columns, and then you add this little formatting and then these lines. And those are all just technical administrative things you have to do on Excel to make it to visualize the table, but the inputs are literally copy and paste. Okay, so the revenue, you're going to look on the income statement, you're going to find the revenue, you're going to find the cost of goods sold, and then you're going to subtract them to get gross profit. Now, as you get into some of these bottom, like middle and bottom rows, where it says operating expense, right? And then there's other income and other expense. So what I would do here is usually the statement will do all the addition subtraction for you. Like it will get you to gross profit, it will get you to operating income, it will get you to earnings before taxes, and it will get you to net income. But you know how back then we talked about how this operating expense actually splits off into many different line items. So this operating expense over here will actually split off into, let's say, let me take a different color, let's say like rent, right? Rent. It could there could be repairs, right? And then there's salaries, right? So many different line items, all of them added together go into this operating expense item. And similarly for the other income and other expense line, you have like foreign exchange costs or gains or losses. You have sale of or disposal of property, disposal of equipment. Those things, you're going to have a few line items also feed into this one sum. So maybe the only thing you have to do is tally them all up if the statement doesn't tally it up for you. Okay, some statements already add all the expenses up, give you a number at the bottom, and then you just have to and then they'll also do the subtraction for you. It just depends on the statement and the level of detail the statement goes into and how the accountants prepare it. In general, I think this table on the left side, it's all copy and paste. Straight up, you just take the information and you copy it into the Excel. Okay, do a little bit of, graphic design and make it look nice. That's something that you have to develop with your own style, with your own preference. But once you have that ready, you notice how in the yellow here, let's see if there's a highlighter. Yeah, there's a highlighter. You notice in the middle here, I left some rows of spaces, and then at the bottom here. So that's where we're gonna go in and we're gonna do our quote unquote, our little touch to make it an operating performance analysis. So all I did, okay, let me switch back to the pen, is if I can draw your attention to this line, and this line. So recall that GM stands for gross margin, and if just as a refresher, the gross margin is just equal to the gross profit, which is this line, it's after the cost of sales, divided by revenues. Okay, that's a pretty basic income statement ratio that you should know for profitability. Recall that what this means is whatever product or service you're selling, what price you subtract how much it costs you to get the, if you're selling a chair, how much does it cost you to make the chair, the cost of goods sold, and then how much are you selling it for. Recall that it has to be positive because that is going to have to absorb, like that's going to determine whether your business model actually works, because whatever this gross margin is, which is, you see, it's 59% in fiscal 24 and 56% in fiscal 25, this margin will have to absorb everything else. In addition to the cost, they'll also have to absorb operating expenses, like how much you pay your staff, how much you pay for rent for the facility. So it's super important, right? The gross margin is actually really important. It's going to tell you how profitable is the business, right? The higher, the better, of course. And recall that for businesses like restaurants, the margin is super thin. It's like the gross margin, if you account for your waiters' salaries and then the food that you're selling, it's actually only like maybe 20%. And I think the salary for your waiters and cooks and stuff doesn't actually go into cost of goods sold sometimes for restaurants or cost of sales. It actually falls into operating expenses. So that narrow like 10-20% margin that you mark up your food and beverage has to even cover like the salary, etc. Okay. And then recall that the margin here, operating margin, is going to be, you guessed it, it's going to be the operating profit divided by revenue. Sorry for the bad writing. I wish I had one of those iPads where I have a pen and I can, just go in and write it out. It'll be much more, much more clean than just using my mouse here. But nevertheless, bear with me here. At the very bottom, profit margin, and again, it follows a similar pattern. Profit margin is just going to be equal to the net income divided by revenue. Okay. So let me just take out all of this writing here and let me just, so that we can just take a look at the actual operating results here. So what you're really trying to interpret from here, if you're going to do an analysis and comment on it, I would comment on the revenues first. From fiscal 24 to 25, the revenues went up. And usually what you want to do, something else that you can add to this table, is how much did the revenue grow? What's the growth percentage of the revenues? So to do that, you just take the 11, so notice that this is in thousands, so this is 11 billion, okay? 11 billion. 11 billion divided by 10 billion, 588. This is just change year over year, okay? This is just basic math. Like there's no formula for this, but you should know this from probably high school or university at least. This is the percent change, and if I plug it into my calculator real quick, 11102 divided by 10588 minus 1. So it comes out to 4.85%. So the revenues went up or grew by 4.85% year over year. Okay, but then when you go down, you see that the gross margin actually shrunk. And then this might be concerning depending on what kind of business it is. If they're a business that negotiates a lot of the price, then it makes sense for it to fluctuate. But if it's a business like clothing, gross margins going down is not a good thing because let's say this business sells clothes. Gross margin going down means you have to reduce the sale price of your clothes in order to make sales. So the sales increase, but at the cost of you having to mark down the prices, which means that the perceived value from the customers of your clothes is lower. Okay, so it's a very big deal for clothing companies actually. And notice that operating margins also suffered year over year from 23.7% to 19.9%. That's actually almost like a 4% decrease. And then same thing with profit margins. Okay, so you can talk about things in percentage terms, and you can talk about things in absolute terms, which means how many millions or how many thousands did it increase or decrease. You can take a look at these numbers, and then you're going to write, as an analyst, you're going to comment on what industry is the borrower in, how did it change year over year. I would say maximum talk about 3 years, and only if it makes sense go more than 3 years, because beyond 3 years, every 3 years the economic environment changes a lot. Like there might be new policies, there might be new things happening in the world. So beyond 3 years, like for example, COVID lasted, I mean, more than 3 years, but the bulk of COVID was 3 years. So I would say if you're looking beyond 3 years in the past, it might not be reflective of the actual business as much as it is the environment might have changed. Hopefully that makes sense. Okay, so the last bit that I would like to talk about is the bottom right. You see all these weird Excel. These are actually from Excel. And I just wanted to highlight how I created the tables. Okay, if you actually open up an Excel, in each of the cells, so how do you get gross margin or whatever? All you have to do is click on, you have to type in equal first, type in equal in the cell, and then click on the gross profit cell, and then just type in divide, and then click on the revenue cell. Okay, and then hit enter, and that will get you your percentage, and then you just change it to a percentage via formatting. Okay, so that's how you interact with Excel. All you really have to do is put equal, type in a number, and you can add, subtract, multiply, and divide. And then the keys for that is multiply is this is the 8, I think shift 8, and then divide is just a slash. Okay, so this is how I got all of these. All you have to do is hit equal, click on the cell like this for profit margin. I put equal here, I click on net income cell, and then I put in a slash, and I click on the revenue cell, and I hit enter, and it will give me this automatically. Okay, just so you know how to really create it, in case you're not familiar with Excel. And then how did I make the pretty, or not pretty, depending on what you think about it. How do you make the headers? All you do is you have to highlight it, just drag your mouse over the 3 cells, and then click on cell styles, and then choose the color and the font that you like. Okay, and then how do you make all of these lines, etc. And how do you shade the cell? How do you format it? Well, there's a font. There's this little island on the on Excel with font at the bottom, and all of these buttons you just interact with. You can put in, the borders. You can shade the cells, etc. So that's how you will recreate what I have here. Okay. Now the screen is super busy, and I've talked already for 14 minutes. I apologize, but one thing I want to say is that this company right here is actually a real company. You know how I was talking about for clothing companies and apparel companies or athleisure stores, the gross margin is going to be a big problem. Well, the financials that I used here is actually for Lululemon. Okay, so let's go to the next slide. So, like we just talked about, Lululemon, which was actually the results that I used, their revenues went up by 4.8%. But upon closer inspection, based on our operating performance analysis over the 2 years, we could see that every margin, gross margin, operating margin, and profit margin, all declined by 3 to 4%. So, like I said, gross margin for a clothing company is so important because when analysts or everybody who's in the industry thinks about gross margin, it not only signals, just a higher, potentially higher cost, but most people, when they dig into the gross margin, they actually think that you're doing more of this. Is called discounting. You know how a lot of clothing companies say, oh, we have a sale. And then if you're in a mall, sometimes you pass by a store and you think, hey, like this store is always having a sale, like permanently having a 40% sale or 30% sale. So what that means is that when the consumer perceives your brand as like, as for example, Lululemon, if the consumers think that you're always going to have sales, then they slowly begin to refuse to buy your products at full price. They're always waiting for the sales or waiting for some kind of discount. And that actually is detrimental because the perceived value of your product, how much you can sell it for, decreases, right? Look at the stock for Lululemon over the past year. It went down 50% because of those results. Okay, so you can see how in the real world it has a real financial impact, right? Now, as a lender, let's bring it back to the perspective of you working at a bank. So we are, let's say, a bank like let's say we are RBC, just as an example. So if we have a loan to them, right? We loan them like let's say $100 million. Are we going to be concerned about these results? Yes, of course, in our analysis, if we're doing an annual review and we do that operating performance analysis, we're going to say, hey, we noticed that the margins are declining. Here's why. Of course, you're going to have to talk to the management to figure out why. But are we really at risk? Is our loan at risk? Well, recall that the net profit or net income, right? Net income, the very bottom of the income statement. It went from 1.8, it was billion, right? It went down to 1.5 billion, if I recall correctly. So this loan that we gave, let's say 100 million versus their net income, although it went from 1.8 billion to 1.5 billion this year, are we concerned that they're not going to be able to make their principal and interest payments? Probably not, right? Probably not. So even though, and the reason why the stock went down is because, well, when people think about how much the company is worth, if the margins are declining and the consumers are changing their perspectives about the products, the company's going to be worth a lot less for analysts and people who are shareholders, yes, but for us as the lenders, like we're just loaning them money. Really, we don't have as much concern because all we care about is, do they still have enough CF or cash flows? Do they have enough cash flows to consistently repay out their debt obligations to us? Okay, and that's pretty much operating results and operating performance analysis. Next, we need to talk about borrowing base. Okay, borrowing base. Borrowing base. Essentially, this pertains to an assessment of a company's working capital. It's basically to test how much of an operating line or operating facility that a business can support. So I'm sure you're familiar with line of credits, right? Our line of credits are different from a company's line of credits. How do we know, like, why are some companies getting line of credits that are like $10 million or $5 million? Like, line of credits as a loan is very different from mortgages or term loans, like that we talked about before. Mortgages, you have the mortgage, and the loan is like you have set principal and interest payments until the loan is paid off, and you only issue the loan one time in the beginning. As soon as you issue it, usually it starts to amortize, or it starts to get paid off every month. But operating lines are very different. Operating lines, you do not have to pay any principal. And then once you draw on the operating line and then you repay it, you can draw on it again. Okay, so this is what we call an uncommitted facility. Um, and it's uncommitted because there's no committed repayment term. That's really what it means. So this is the other type of lending that banks do. There's really only two types: committed or uncommitted. Committed means you pay them back. You give them a loan for a specific purpose. They have to pay you back in installments every month, every quarter, every year until it's completely paid off. Or uncommitted, where you give them this kind of operating facility and they can use it whenever they want. They just have to pay interest every month usually. So how do we know, how does a company qualify for, let's say, a $10 million line of credit? Really, we have to make sure that the amount of turnover, or how much working capital they have, is roughly equal to the line size, or how big the operating line is going to be. So let's follow through. Like, don't worry about each of the columns. They just break them out into January, February, March, April, May. They just break them out into different months, but the subject matter on each column is the same. Okay, so let's start with the top. You have the accounts receivable. You take this either straight off of the financial statements if it's for the year, or the borrower is going to provide you with something called an AR listing, and that's going to tell you how much accounts receivable they have. Recall that accounts receivable is basically how much customers have bought of your product on credit. So maybe they paid it with their credit card, or maybe they made a purchase, but they're going to pay you in 30 days, like later, but they haven't paid you yet. So that's accounts receivable, right? And what we're going to do is, let's look at January. So January, there's 10 million. Again, just to get you familiar with how the analysis usually works, it's usually in thousands for commercial banking and above, just because of the volume of transactions that we're dealing with, or how big the companies are. So we have $10 million in accounts receivable that's owing, but we have to deduct. In this case, we're deducting over 90s. We always have to really deduct over 90s. What over 90s mean is, these are the customers that bought something from us, but they haven't paid back in over 90 days. So the rule of thumb is, when they don't pay you back in over 90 days, you're considering that they're probably never going to pay you back. Okay, that's the general rule of thumb, that you can't really count it as accounts receivable if it's overdue for that long. Like, for example, if your friend borrows money from you and they haven't paid you back in 5 years, like, what are the chances that they're actually going to pay you back, right? Pretty low. So that's why we deduct it, we subtract it, and then we get 9 million of actual eligible accounts receivable. Now, this is not the only thing that we deduct. There's other things that we deduct, but again, for the purposes of teaching you borrowing base and margining, we're going to keep it simple and just assume that only the over 90s need to be deducted. There's other things that need to be deducted. Like, for example, if you, like, as a business, let's say you owe your employees salary and you never paid them yet, or you owe them like some kind of benefits that you never paid them, you have to deduct that from your accounts receivable too, because, like, as soon as you receive it, that has priority over you getting the money for, like you taking the money into your business, because you have to actually you have to pay out your employees first. So those are also things that you can deduct, but to keep it simple, we're only deducting over 90s. Okay. Um, and then in terms of eligible ARs, after you deduct it, we have 9 million. And the margining rate for accounts receivable is 75%. So what that means is that, yes, we have 9 million in accounts receivable, but to determine how much coverage that we give, like how much of a line of credit we're going to give on that 9 million for accounts receivable, we're not going to give them 100%, right? Because worst comes to worst, and there's some kind of default for the borrower, you can't, and you take the accounts receivable, the reality is you're probably not going to collect all 9 million of this, even if they're in default, and now as the bank you're the one who gets all the accounts receivable as collateral. You probably can't collect all of that. So the general rule of thumb is 75% of this, right? And that's how we get to the actual AR coverage of 6.7 million for AR. And then we also do it for inventory. So those are really the two things that we margin. They're the liquid assets as part of working capital, accounts receivable, and inventory. Inventory is basically the stuff like, let's say, the Lululemon example is all of the clothes, right, that they have on their racks and in their warehouses. So let's say they have 6 million, right, 6 million in inventory. The inventory is actually margined at even a lower rate than accounts receivable. And the reason is because accounts receivable, when you make a sale, technically the customer has a legal obligation to pay you, and unless they declare bankruptcy or something, it's very hard for them to get out of paying you that accounts receivable unless you have a really shady transaction and you're selling to really shady people. But usually the accounts receivable, you're going to get most of it. They just owe you money. Whereas inventory, if you think about inventory, you actually have to take, in the case of Lululemon, all of those like clothes and those leggings in the stores and in the warehouses. You have to, as the bank, spend money to hire somebody to take them to the market and sell them. And how much money can you recover from $6 million of, let's say, leggings? Well, if you want to sell it fast, the faster you want to sell it, the less you're going to get back. So even though they say this is $6 million worth, when you put it on the market, you might only get like 50% is the rule of thumb, right? So that's how much margin or how much credit we give them for the inventory. So the inventory coverage then for $6 million in inventory is only 3 million. And then what we do is the total coverage, you just add the two up. You add the accounts receivable coverage and then the inventory coverage. So 6.7 and 3, you get 9.75 million as of January. Okay. And you know that the accounts receivable inventory values, they change, right? They change every month. They actually change every day. But we only calculate them maybe monthly. And for really large operating line of credit, like if we're going to give a company like $10 million in operating line of credit, right? $10 million, let's say we give them $10 million. Does this justify, does the base, the borrowing base, comprised of eligible accounts receivable and eligible inventory, is that enough? Does this coverage justify the limit? Well, yeah, it does. It's kind of close to 10 million, right? It's not always at 10 million, but it's close to 10 million. So if we give them a $10 million line of credit, we know we're comfortable that they should have about, like enough coverage, enough borrowing base to support the 10 million. Now, do they qualify for 20 million? Well, no, because all of their accounts receivable and inventory based on our assessment here, our borrowing base coverage assessment, you only get total coverage of about 10 million. So we can't give them a $20 million line of credit. Okay. So this is how a bank assesses how big of an operating line to offer. their clients, and oftentimes they're gonna monitor this after they do an analysis based on their accounts receivable and inventory listing, which are basically just documents that the client provide to tell you how much inventory they have and how much accounts receivable they have. After they verify it, they actually continuously monitor how much coverage they have, because this the level of accounts receivable and inventory will increase or decrease based on how much business that the client actually does, right? So if in the case of Lululemon, again, just because we use the example, it, if their business is going well and they're growing and expanding and they open up a lot of other stores, they're probably going to need more inventory and they're probably going to have more accounts receivable because there's more stores and people are buying on credit cards, etc. So there's going to be more AR. So the line of credit we're going to give them as they grow is going to increase, right? Now, on the other hand, if the Lululemon's closing down stores, the company has a bunch of Lululemons, they close down the store here and there because people don't want to buy as much Lululemon anymore. Then they're going to carry less inventory. Then the accounts receivables will decrease. Then we have to look at scaling back their line of credit. Okay, so you know, um, I included multiple months because you can't really rely on just one data point to determine whether they should have a $10 million line of credit. You need to actually look at how much coverage they have over time. And that's why I included multiple columns. But don't worry about all the content is exactly the same. And then from top to bottom is how we calculate everything for the borrowing base coverage. So I know it's a bit much, but if you have any questions, please do not hesitate to come clear things up with me. Okay? Just realized that this video is going to be an absolute banger. We're already at 31 minutes. I apologize. I know you don't want to listen to me ramble on for this long, but we're close to the end. Okay, so the last topic to cover, and then you have all the fundamentals that you need. The last topic is loan to value. I think this one's going to be an easier one, not as much technical stuff. So hope you enjoy this. Okay, so on the left you have a doctor, all right, and on the right you have some average Joe, average schmuck, with t-shirts and jean shorts. Okay, they both want to ask you for a $1 million loan. All right, so this is a really interesting analogy to talk about loan to value. Now the question is, like, if they approach you and you're the bank, you have a doctor and some average Joe asking you for $1 million, who are you more likely to loan it to, right? Probably the doctor. And why is that, right? Why are you more willing to loan the money to the doctor and not to the average Joe? Because you probably know, like, that doctors make a lot of money. If you can verify that they're a doctor and they're practicing, they're probably making at least 250K and above, maybe 300 and 400. So they can take on this loan, right? Whereas the average Joe, well, even if they have a regular job, that maybe the average, I think, medium income in Canada is 50 or maybe 40 something, but around 50, I'd say, 50K. Um, like, they might not be able to pay back the $1 million loan, especially if they have other credit card debt, etc. So right off the top, you're very reluctant to give the average Joe $1 million of lending. But there is a way for him to get the $1 million loan. Okay, and that's where loan to value comes into play. Loan to value. Let's break down this phrase here. Right, you have a loan. To just means versus. Okay, value. What is the ratio of how much you're asking for and how much value it's actually talking about collateral? Okay, so how much security are you willing to give? Collateral, in the case of a mortgage, your collateral is the house that you're buying. The bank has the title to the house until you pay off the mortgage, right? If you don't pay it off, the bank gets the house. So the bank will they loan you 100% of the house's value? No, right? That's the loan to value. They usually loan you for the mortgage, like your down payment covers a portion of the value. So you can do as low as 5% nowadays, I think. Um, correct. Don't quote me on that. In Canada, I think 5%, which means that your loan to value when you purchase the house is actually 95%. Now, as the house changes in price, this loan to value will change as well. Okay. But this is how this average Joe is going to be able to borrow $1 million. Okay. If he has some collateral, it's possible. All right. Now I added a few more items onto this slide. Um, we still have the ask of $1 million. So now let's say the average Joe is not just an average Joe. He recently won the lottery, and with his lottery, he bought a Mercedes and he bought a mansion. Okay, so now he has some assets that he can pledge as collateral. He can say, "Hey, I own this house and this car outright. Um, I'll put it. I promise to pay you back. And how do I like? I know my income is not very stable. Sometimes it's 50K, sometimes it's 100K. Like let's say he does, those kind of he does some kind of sales, right? And the income is very volatile. Okay, he's in sales. He doesn't only make 50K, but it could be like every year he could make maybe as low as 20K and as high as like 150K. But he wants to borrow $1 million. So normally as a bank, we probably wouldn't lend him $1 million, but he has collateral, right? So down here, I recorded his Mercedes and his mansion. So he's telling us that based on the market price, he just bought it. Let's assume he bought both of them brand new. He's saying he bought it for 150K, the Mercedes, and then he bought the mansion for 1.5 million. But as the bank, are we gonna like when we calculate the loan to value, are we gonna give him for the value part, are we gonna give him the full amount? No. And this is for the same reason as we just talked about. If we took the Mercedes in the future and we sold it, we probably not gonna get 150K back. Same with the mansion. So we're gonna do our own analysis and figure out every bank does this a little differently. So there's no standard, right? You just have to follow what the bank how the bank assesses the collateral value. But after doing some analysis on the Mercedes and the mansion, the bank says, okay, so the Mercedes, we're going to give it a value of 100K. And the mansion, we're going to give it a value of 1.25 million. So the total collateral value we're going to give Joe is $1.35 million. This is the total collateral value. Now he's asking for a loan of $1 million. So what's the loan to value? The loan to value is literally the loan, 1 million, divided by the value, which is 1.35. When you do that division, that simple division, this divided by this, you get 74%. Okay, so then we say, okay, Joe, we'll loan it to you. This is going to be 74%. So we know that if Joe can't pay us back for some reason, if he defaults, we can take his Mercedes and his mansion, and we have a margin of safety. You know how the loan to value is only 74%. So what's going on with the other 16%? Well, that's just in case the market fluctuates. We can still be confident that we're going to recover all of the money that we loan him. And that's the idea of something called recourse lending. Recourse means that there is an action that we can take. There is collateral that exists and the action that we can take in order to exercise the security. Okay, that's called recourse lending, and it's also called asset-backed or asset-based lending. It's we lend, and our primary, like the bank's primary assessment is based on how much collateral they have. And we're confident in making the loan, not because their cash flows are very stable, but because they have a lot of assets that they can support their loan with. Even if they don't pay, we can take his assets and sell it and get our money back. Okay. Then there's another kind of lending called non-recourse lending, or also you might have heard of this, uh, cash flow lending. Cash flow lending is actually, when it comes to commercial banking, corporate banking, whatever, like when it comes to businesses, it's more interesting. And the reason why is because all that we're going to get from the doctor is going to be an IOU. She's going to say, okay, any income I make, you have the right to any of the income that I make in my business. Or for her, let's just say she says we can, from a personal level, she just says you have rights to all the income that I make if I don't pay you back forever. Okay, so all we have is, there's no assets. All we have is an IOU. So how are we comfortable also lending her the $1 million? It's because, as the name suggests, cash flow. She has a lot of cash flow. So we do some analysis based on her T4 and her, tax documents, and we figure out that she makes 200, and let's make it more realistic. Realistically, it's probably more like $350,000 a year, right? After taxes, of course, it might be lower and whatnot, but she has a lot of cash flow to pay the loan off with. So once we do our analysis and we figure out that she can make this much per year, and that means that it's only going to take 3 years for this level of cash flow. If she wanted to, 3 years is all it's going to take to pay back the loan. Assuming she doesn't have any other debt, we probably approve her, okay, because she has such strong cash flow. Now, this is just an analogy, but for loan to value, like most businesses, when they try to buy a facility, we treat it the same way as a mortgage. We take the facility as collateral. We actually take a mortgage on the commercial property, and then we assess the value of it, and that's really the concept of loan to value here. Okay, but cash flow lending, there is a version of lending where we'll give them a term loan, and then we won't ask for any security. It's going to be a term loan just based on their ability to generate cash flows. And that's what's most interesting in finance, I would say. In all of finance, the most interesting and the most complex deals are written when you are lending to a business where they're pledging no collateral other than an IOU. And in commercial banking, this IOU is called a GSA. Okay. All right, and that should wrap up all of our topics. Hopefully, this is pretty much a one take, so I apologize again if it's a little bit stuttery or redundant, but I appreciate you for joining me through all of the modules here, and I'll see about putting together some kind of practice. But otherwise, all the best. Feel free to reach out if you need.